Hi everyone, Megan Marsh here with Select Mortgage in Erie, Pennsylvania, bringing you your most recent mortgage information. What we're going to talk about today is the cost of your credit score. And I wanted to go over this because I had a situation in the last week where a borrower got frustrated with the costs of the loan. So I want to go over them with you because this is something you're not really going to understand until you go in and you sit down with your loan officer and they go over these costs. So I did one of my charts. You're going to notice as I go through these that I like charts. I like comparing things. And this chart right here, and I'm also going to post it below the blog like I did last week. And this is what a conventional loan, what the pricing adjustments are. And what that means is if you look at this chart here, it shows you credit scores and it goes down. Credit scores go from a 350 to an 850. And it starts any credit scores that are over 740, 720 to 739, 700 to 719. It goes sequentially. And then up here, this is your loan to value. What that means is how much money are you putting down. If you're putting 20% down on a loan, you're going to have an 80% loan to value. So here's my little example to show you. And every bank everywhere follows these rules. If you're going to what's called a conventional saleable loan, it doesn't matter where you're going, these hits apply. And it's not the bank that's charging you. It's the secondary market. It's if you've ever heard of Freddie Mac and Fannie Mae, they're the ones that set the rules and they are the ones who determine these costs. And this is a fairly new thing. It's been going on for about a year, year and a half, but they've adjusted these just in the last few months. So my example here to show you how this works is if you're purchasing a home for $125,000 and you're putting 20% down, so your loan amount is $100,000. That's your loan. If you have a credit score of a 730, you're going to go up here. Your credit score is right here, 730. You're putting 20% down, so you have an 80% loan to value. Your charge is 0.5, which on $100,000 loans, 0.5 times 100,000 is $500. That's what you're getting charged above and beyond your normal closing costs and your prepaid items. Let's say your score drops down to a 665. Let's go down, 665. Over to the 80%, you're getting charged 2.5 points. That's $2,500. And you need to know this because like I talked about in a previous blog, there's costs associated with the loan why you can't just shop for your interest rates because your interest rates may change depending on your score. Most places have to charge you outright for these costs. There are some lending institutions, there's some lenders, they can roll the costs into the rate. So you could get a higher rate and not pay these costs. You're paying them over the life of the loan, but at least if you're a little short on cash, you want to try to find somewhere. A broker, for example, which I know about broker rules, you can roll the cost into the interest rate and not have to pay them at closing. Also, there's adjustments and hits for cash outs, second mortgages, loan amounts, escrows, and you'll see that on the sheet I'm going to post below. Also, I wanted to make a note, FHA loans don't have these same rules. These are just for conventional mortgages that are greater than a 15-year loan, so like a 20 or a 30-year loan. These are what their costs are. And then next week, if you tune in next week, I'm going to go over credit scores, how they work, how they're determined, how you can improve your credit score, and what type of score you need to do certain types of loans. So thank you for listening today. I hope you tune in next week. And if you have any questions for me, you can email me at megan@selectmortgageerie.com. Thanks for listening.